Why does the system reward debt instead of saving? You're encouraged to borrow for homes, cars, education, even everyday spending. But when you save your money, quietly loses value over time. Also, here's the real question. If saving is responsible behavior, why is debt the engine that keeps the economy running? To answer that, we have to look at how money is actually created. This isn't a topic reserved for economists or bankers. It affects why housing prices rise faster than wages, why inflation never fully disappears, why debt feels unavoidable, why financial stress exists even in good economies. Most people assume money comes from governments printing it. In reality, most money you use every day is created by banks quietly, digitally, and legally. Understanding this doesn't change the system overnight, but it changes how you interpret what's happening around you. Step 1. Where people think money comes from. Most people imagine money being created like this. Government prints cash, gives banks lend that cash, gives people spend it. That still happens, but it's no longer the main source of money. Step 2. How money is actually created. Let's walk through a simple example. You walk into a bank and apply for a loan. The bank doesn't check a vault to see if someone else's money is available. Instead, when your loan is approved, the bank creates a deposit in your account, records a loan on its balance sheet. That deposit did not exist before the loan. It is new money created through credit. This process is called fractional reserve banking and credit creation. Step 3. Why this isn't illegal or hidden. This system is legal, regulated, and built into modern economies. Banks are required to hold reserves, manage risk, follow capital rules. They don't create unlimited money. But within those limits, lending is how money enters circulation. Step 4. Why debt is central to the system. Here's the key detail most people miss. When a loan is repaid, the money disappears. When interest is paid, it stays. This creates a cycle. New loans create money. Repayment removes money. More loans are needed to maintain growth. That's why the system favors borrowing. It's not because saving is bad, but because debt is how money is introduced into the economy. Step 5. What this means in real life. This helps explain why asset prices rise over time. Inflation trends upward. Credit is constantly promoted. Economic slowdowns happen when lending slows. The system expands through lending. When lending slows, pressure appears. Banks don't create money to deceive people. They operate inside a system designed around credit-based growth. Once you understand how money is created, the economy stops feeling chaotic. It starts looking like a structure with incentives, limits, and consequences. And understanding the system helps you make better decisions. If you found this explanation useful, consider subscribing to The Unseen Market. We focus on how financial systems actually work beyond headlines, hype, and noise. New videos are released regularly, breaking down the forces that move before most people notice.